House, Senior Economist with Wells Fargo's Corporate and Investment Bank. And today I'm joined by my colleague, Michael Puglisi, to talk about the outlook for potential growth in the coming years and what that means for the economy and interest rates. So Mike, first things first, what is potential growth and why should we care?
Yeah, thanks, Sarah. So, potential growth or potential GDP growth is the sustainable rate at which the economy can grow over the long run. And so, if you think about the short run in economics, we often think about that in terms of the GDP equation you maybe learned at one point. So, C plus I plus G plus NX equals GDP. And so, that's derived from the spending side. But over the longer run, we think about the economy's growth potential in terms of its ability to produce goods and services. And so I kind of like to think about this in terms of like running a race as an analogy. So you could maybe run a race for the first mile at a super fast pace, but could you sustain that over the whole race if you're running it at a full sprint? Probably not. And so when we think about potential growth, we're thinking about what could be sustained over a long period of time for growth in the United States or in any economy. And in terms of why we should care about it, that sustainable run rate has really important implications for GDP growth and by extension, household income growth, business profit growth, real interest rates and long-term interest rates in the economy. And so trying to measure or estimate that and also projecting it forward can be a really important exercise as we figure out what is the cruising altitude for the US economy going forward. But before we talk about that, Sarah, what was happening with potential growth estimates before COVID, say in the decade leading up to 2020?
So we actually saw a notable downshift in the rate of potential growth over the past decade. So the CBO estimates that it averaged just 1.7%. To put that in perspective, potential growth averaged 3% from the 1970s to the first decade of the 2000s. And the reason for the slowdown were multiple. So in terms of labor, you had slower growth in the working age population. Baby boomers were reaching retirement age. You also had very low participation coming out of the Great Recession. In terms of capital, there weren't a lot of great investment opportunities just given how slow demand was as households had to deliver. And with productivity, we saw that slowing down even before the Great Recession. So we saw the effects of the internet boom beginning to fizzle out already, less boost from the adoption of personal computers. And so what we saw was a pretty consistent downward revision, not just from the CBO, but also from the Fed in terms of thinking where potential growth was over the long run.
So what about the 2020, Sarah? I mean, how are you thinking about the decade ahead? Are we looking at another, lower for longer, slow growth period like we had in the 2010s? Or are you thinking there might be something that shakes it up as we look ahead to the next decade?
Well, there's still a lot of uncertainty about this. So, we're in the middle of a pandemic still. But when we step back and we look at both, the upside case and the downside case, we think that overall there's scope for potential growth to improve over the coming decade. So going back to our three major factors. So when you think about labor force growth, so yes, the demographics are still pretty formidable, but if you think about the policy response, both in terms of monetary but also fiscal, we've seen that how forceful that was, we think is going to lead to less labor market scarring. We saw over the prior decade that if you leave the economy running hot enough and you have a strong labor market for a number of years, you do see workers come back into the fold. So we saw this with the prime participation rate climbing pretty quickly over the latter part of the past expansion, almost getting back up to where it was in 2007. On the capital front, we've already seen private companies adopt new technologies pretty quickly here. In terms of public investment, the outlook there looks very different than what we saw in the 2010s. So there's much bigger appetite for public spending when you think of things like infrastructure. State and local governments actually have the means to invest this time around as compared to the 2010s. And then on the productivity front, so this is always a bit of a wild card, but when we step back and look at the recent rate of productivity growth, it was so low in the prior expansion. In some ways, there's only one way to go from here. And we actually did see productivity beginning to pick up at the last part of the decade. So when we step back and look at what that all means and putting those components together, year, we think that we probably could see potential growth get a little bit above 2% as compared to, that 1.7, 1.8 range that was estimated over the prior decade. Now, Mike, that has a lot of different implications for the economy. Can you walk us through some of those?
Yeah, so it might seem like semantics in terms of 1.7 versus 2.1 or 1.8 versus 2.2, but there are some important implications there. One, even small differences in growth can compound over long periods of time. And we're talking about a decade like this. If you take our estimate for potential growth through the end of the 2020s and compare it to the Congressional Budget Offices as an example, we've got an economy that on a potential basis is about 5% bigger than it is in CBO's estimate, which 5% on trillions of dollars can certainly add up. So there's a compounding effect even with small differences. And then two, even if the magnitude is a little up for debate, a couple tenths either way, directionally seeing potential growth that is maybe revised up a little versus continuously revised down like it was in the past decade could have some important implications. And here's just one as an example. So lower potential growth should be associated with lower interest rates, as the return you get on an investment economy-wide isn't as good as the economy has much slower growth rates overall. And in fact, that's what you saw in the 2010s. Now, there were lots of factors that led to low interest rates over that period related to low inflation and a global savings glut. And so it's certainly not exclusive to this, but certainly one factor was those significant downward revisions to the potential growth rate of the US economy over the 2010s. And so if we could even just directionally get a little bit higher over the next decade, that should help a little bit at least reassure people that we're not going to see continuously downward revisions there, not just to potential growth, but to long-term interest rates more broadly. If you look at the Fed's long-run dot over the 2010s, that's exactly what you saw. It started in that 4.5% range, and then kept drifting lower and lower down to around 2.5% at present. But since then, it's held pretty steady in terms of what they've done since the pandemic began. And part of that is probably just because the Fed doesn't have a ton of visibility into long-run changes in the economy yet. But as we start to think about them, as the Fed starts to think about them, the potential growth story, at least, is an argument that they may not have to keep downwardly revising that long-run dot going forward, at least when it comes to the growth impact. So certainly some implications there for the return on investment, growth, long-term interest rates, etc.
Well, thanks, Mike, for joining us and helping us shed light on these important changes that may be underfoot. From all of us at Wells Fargo, thanks for tuning in to our latest economic insights.